What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies. And if you stick with me towards the end of the video, I've got 5 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description. And without further ado, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this week, I would certainly classify this as a indecisive bearish candle. The reason being, of course, is the fact that our upper wick and the lower wick are both significant in terms of size, and both of them would represent some buying activity, right? We did actually buy here and take out the prior week's high. We'll talk about location in just a second. So buying activity at the highs and also buying activity off of the lows, right? Preventing the weekly close to be dead on the lows, but certainly don't get me wrong, it's just here at the lower third of the weekly range. So overall, structure does fall into the bear category, but we should acknowledge the buying pressure that took place on both ends of the spectrum. Going back to location now, obviously we did make a bar-to-bar higher high and a bar-to-bar lower low. I'm really more concerned with the lower low, and I'll talk about why on the daily time frame in just a second, than I am with the higher high. I would say that because we have an outside bar, it should be easier to start a new trend here, right? If we're going to get a move, we should produce some sort of higher high and higher low, or the exact opposite, right? A lower high and a lower low, considering that this is above, right? So the odds would favor that whatever the high or low is would be inside of this bar's range. If that makes any sense, or if that's confusing, I apologize. But nonetheless, when you have an outside bar, it's easier to start a new trend, right? That's all I'm getting at here. So what else do we have from a location standpoint? Obviously tying in pattern, which we have been discussing for a couple of weeks now. There you go. There's your head and shoulders. There, of course, is the neckline. 2 weeks of price acceptance underneath the neckline. That does strike me as a bearish implication. Getting price acceptance, again, just underneath that breakdown point without really trying to rally hard against it and get any sort of price action moves that would take out the neckline and invalidate this sort of pattern. So again, falling into the bear category here. 2 things that we discussed in last week's video were the high volume node, which were right here, as well as the anchored VWAP coming from the sickness lows. They did provide some support. Again, notice the lower wick on the weekly time frame here, but really it didn't really result in any sort of major meaningful bounce. We talked about that in last week's video, but we did get the pause that we were ultimately looking for at those 2 areas. Let's drill down to the daily now and start talking about tradable levels into the upcoming week and see what we have on the docket here. I'll describe why those lows were concerning to me, those weekly lower lows that I was just discussing. So nonetheless, before we do so, obviously the gray shaded area is our weekly expected move. Notice that the top end of that weekly expected move is aligned with this 405 level on our charts. To me, this is going to be a critical level if we see any sort of upside follow through. I'll describe why I think that could be a possibility. And then to the downside, the low end of the weekly expected move is just undercutting the low of Friday's session. Wicked volatility there. So if we do start to dribble lower, I would carry that forward as a significant area here on the chart. That's going to be, if you want to use the weekly expected move level, it's 377.10, roughly that area. Underneath that, we do have 371 as support. We'll talk about that in just a moment. But for now, let's go back and think about basic technical analysis, and we'll also describe the weekly low situation. So what type of candle did we print on Friday's session? A hammer candle, right? That would mean that the buyers stepped up at the lows. Is this happening at an area of support? 385 from right around here. I would say absolutely yes, it is. So it would be reasonable to think that if we take out the 2-bar highs, then because we have buyers already responding at an area of support, there's possibility for continuation to the upside or some sort of reversal from this hammer candle. Again, this is like technical analysis 101 in terms of reading the candlestick. So that's reason number 1 why if we take out this level here, 395.50 area, we could see the top end of the weekly expected move. Now, something that is really more psychological than that and location based is if we think about H patterns, right? You get something like this. We're traditionally looking for these to break down and see follow through to the downside. It's a bearish pattern, no doubt about it. You have a lower high, you're coming off of a downtrend. You could call it a bear flag, whatever you want to call it, that's fine. It has bearish implications. But the fact that we explored underneath the breakdown point on Friday and were unable able to close underneath, right? We sucked back up and closed inside of this range here, would imply to me that any sellers who were selling it down here or on the break are now underwater. Again, I do think a lot of this activity was short covering into the close. No one wants to hold this short throughout the weekend with headline risk, but nonetheless, it means that the sellers weren't as strong as they potentially appeared on the breakdown of this level. So that, again, the failed H pattern here, Peter Resnicek from shadowtrader.net, who unfortunately stopped his weekend videos, used to say that H can also stand for hell for shorts if we get this exact scenario. So again, shorts trapped here. If they start to close out and give us added buying pressure, I use this term very lightly, right? Short squeeze could be underway up and over this 395.50 to the top end of the weekly expected move. That's just what I'm thinking about as we move into the earlier part of this upcoming week's worth of trade. Obviously, we'll keep you updated on the Wednesday video. And the other way you could look at this, there's just so many ways to analyze this, right? If you think about this as a range, highs, lows, right? Technically, we've already experienced a look above and fail, move to the bottom end of the range. Is Friday's little lower wick here going to be a look below and fail, and again take us to the top end of the balance range here at 405? It's certainly another reasonable thing to be thinking about based on the structure that we have in front of us. So those are my thoughts on the S&P 500 as of right now. Let me quickly remind you that even if we do rally into 405, it doesn't really change things. If we take out the Fibonacci's from the top of our last little rally from right around in here, right, and move all the way down towards these lows, notice that we're still underneath our 38.2. So technically speaking, this does constitute bear flag consolidation down here in the grand scheme, something like the weekly time frame, right? And then we are looking for lower after that. And as we'll see in just a moment, our sectors are also continuing to support the idea of risk off. So that's what I would say about upside. Obviously, if this is going to turn into a longer term reversal, if you think about double bottom, it would have to recapture 405 and give us a higher low, something here. If this is, again, just going to become a better reversal off of these lows, I don't necessarily think that a bottom is in place just yet, again, based on the sectors. We'll talk about that in just a second, but quickly covering downside. Let's say we never take out the 2-day highs. We just consolidate in here and then take out that 385 again to the downside. Weekly low end of the expected move is going to be around, let's just roughly call it 377. And then we know we have 371 coming from support. If we scrunch up the chart and grab an extra year or two here, you'll be able to see this. We've talked about it in the past, double bottom from here, right? Touch 1 and touch 2, that's your 371. So that's the S&P analysis in a nutshell. Let's quickly take a look through our sector charts and see how the structure is shaping up in those guys. XLV is first up on the chopping block. Notice that we are getting sort of bear flag acceptance underneath this 133.50 area. In the end of the week, we did get a little bit of a perking up here, so we do have a higher low phenomenon starting, but next up we need the higher high, right? So in this one, I would primarily watch early on in the week. Can we get into, let me flip tools really quick. Can we get into this high around 131.25 and start to reverse the trend, right? We already have the higher low. Can we produce the higher high is the next question. And remembering that the XLV is a heavy weighted sector in the S&P 500, maybe that's something to watch out for, but it still has a lot of work to do to prove itself if this is going to be a bottom in the S&P, right? Next up, we see real estate, just a bear flag. Notice that this one did not violate its H pattern lows, so there's still potential that this acts as a breakdown point at 41.50, so that should take you lower here. Obviously, continue to be a drag for the S&P 500. Energy continues to look fantastic, just sitting up here at the highs. Remember that this is just sort of continuing to perpetuate the idea that risk is off. This is a defensive sector and it's hanging out here at its highs. So again, it just continues that narrative. Same sort of idea here in utilities. Don't get me wrong. We have the whole head and shoulders pattern, but it's not breaking down underneath this neckline. It's really just more neutral in this overall range. What we want to avoid is anything that breaks out and immediately moves back up towards this 77 handle. I would say as long as it consolidates sideways in here, that would be just fine for the S&P 500. And obviously any breakdowns of the head and shoulders continue to put pressure lower on the S&P 500. XLC for communications. What's going on here just in terms of tracking our highs and lows? Notice, so pretty sloppy, right? But there's an H pattern lower. Here is another H pattern. We didn't violate that low. There's still potential for this one to move lower. Just like we talked about in the healthcare sector, if you're going to watch for any meaningful reversal, it's got to take out this 59 and then do something like this for a higher low if it's going to change change the trend. Obviously, as of right now, this consolidation lower here strikes me as a bearish implication. In the short term, though, yes, just like the S&P 500, this hammer could result in some sort of bounce if we crack that 59, but let it prove it to you first. Don't go fishing for bottoms until the market wants to prove it to us. So XLC strikes me as bearish overall, but with the potential to break out up and over 59, let's ultimately see if we can form a higher low and reverse the trend. A lot of work to still be done. Obviously, the XLK, the heaviest weighted sector of them all, perhaps the most important. This one looking much more similar to the S&P 500, obviously with that lower wick, taking out the prior one there. So again, if we take out the 2-day highs, I would be looking for a back test of this level right here around 139.15. That would strike me as something that would support the idea that the S&P 500 would follow suit and get to that 405 level, right? It doesn't change the trend for a major bottom just yet, but it would imply that we could have some early week upside lift, and then after that, we would reevaluate. And again, I'll keep you posted on the Wednesday video if we make it there in the first place. From here, again, there's potential that you get double bottom, right? Something that does this, but we know that doesn't really trigger as a pattern until we take out the neckline, which would require a higher high, if not then a higher low for something that does that. So overall, just note that a majority of our sectors, the meaningful ones, are still in downtrends, but there's the possibility we see a little bit of a bounce early on in the beginning of this week. Same thing with the XLP, absolutely hammered. We know that that was the case on the Wednesday session with Target earnings, really just demolishing everything. A little bit oversold. I sort of mentioned in the Wednesday video that I wouldn't be chasing it short down here. I would maintain that stance. Notice again, we have the hammer candle on Friday. Any sort of lift here could get shorts who are late to the party feeling, not so good about that position, and added buying pressure, again, quote unquote short squeeze, gets us back up through some of this thin range. I wouldn't really trade for that bounce here. I would just wait to see how the dust settles. Do we start forming higher lows, so on and so forth, and then just get back into basic trend analysis once this thing sort of stabilizes after this nasty blow to the downside. Next up, XLF for financials. What's going on in this one? Same idea as the XLK, really. H pattern sort of undercut the low by just a little bit. I do think it could move here early on into the upcoming week, again, supporting the idea that SPY gets to 405. That's 34.25 here in the XLF. And again, if it's going to be a double bottom, that's actually got to get taken out to trigger that pattern and indicate, again, there's a possibility for some sort of short-term reversal, right? XLB for materials, nothing really interesting happening in here. Still respecting that 80 level as support. That strikes me as good, as long as it just remains sideways, not a big bearish drag. Industrials, what's going on in this one? This one actually is a bigger drag. Notice that we actually closed underneath the breakdown point, right? So if you think about H pattern, would have looked something like this, right? We closed underneath that on the Friday session. So this actually does strike me as being poised to go lower, even with the lower wick that we experienced on the Friday session, just based purely on location, right? And undercutting that low, but staying right on it, okay? So it's not the heaviest weighted sector, but obviously any bearish drag is still bearish drag for our S&P 500. And then last but not least, we have the XLY for the consumer discretionary sector. Obviously, this one very similar. Tesla completely falling off of a cliff on that Friday session. Again, to me, this one looks poised to go lower for the same reasons that I just discussed in the XLI. Notice that, again, if this were to turn into a double bottom, a lot of work to be done if it's even going to come remotely close to that neckline around 152.80. So based on the sectors, again, I think some of them are positioned to get SPY to that 405, but not much more than that, right? Obviously, risk still does remain in the off category. If we just quickly take a peek at our ratio sectors, so up here in the top four, we know that we need, not just one, which would be our XLV, which has been relatively strong, pointing upward. We need at least three to be pointing higher to be back in risk on mode, and we just currently don't have that. Obviously, XLY continues to look horrendous here. XLF actually is starting to surprise me, just holding up sideways in this range. It's obviously at the top end. I would want to see the 50 estimated gold line start to reverse back higher before starting to feel slightly more comfortable about a more meaningful bottom in financials, or at least relative strength coming into the financial sector. And the same thing, obviously, with the XLK. Sure, we have a double bottom in place, but lower highs puts us in a descending triangle. Obviously, the outlook for that pattern is lower. In terms of our risk off sectors, they continue to look great. Remember that, again, we need three at least of these to be deteriorating before we would say, okay, risk off is sort of waning here. Notice that energy looks fantastic. Utilities look fantastic. This is getting tangled up around an upward sloping 50 SMA here in real estate, and we're just coming in for a pullback in consumer staples to an upward sloping 50 SMA in consumer staples. So overall, obviously risk off from a sector perspective. Let's quickly take a look at our internals here on the Friday session. Mainly what I wanted to point out was still just the fact that we've been seeing insanely high degrees of correlation, which mean whipsaws will be all over the place in this market. Notice that we opened up on the Friday session above 2,000. We fade all the way to negative 2,000. That is intense. And to see this rip into the close as we get some short covering, because again, I do really think that it was just short covering. You don't get something that looks like this and say, oh, wow, into the close, these are new money buyers coming in, expecting a massive reversal over the next, 2, 3, 4, 5 weeks, right? That's just not how it works. These are people who don't want to hold short over the weekend, closing out into the bell. And again, that's evident here in the advanced decline as well, noting that, sure, it did rip higher, but it did not take out the zero line there into the afternoon close. Obviously, our ticks would support a theory that obviously everything was bearish on Friday as well. And the same thing with our volume read, getting close to zero, but certainly not positive. So internals also supporting the idea that in the grand scheme of things, the positioning and the underpinnings of the market still are in a bearish position. Next up, we're going to take a quick peek at the VIX. And what do we see here? I just want to reiterate the fact that we're playing around in this box. I don't think we've seen a bottom because this really hasn't spiked or done anything nasty here. I think a lot of people, and I've seen some theories on Twitter and, people talk all the time, but nonetheless, because retail is of the mindset that if you just hold on to everything forever, which again, I'm not saying is a bad strategy if you have the right timeline, we're not seeing retail just dumping in mass, right? So sure, institutions might start to sell off because they have to actually rotate things and keep up with what the market's doing and the sector rotations, the seasonality, all that nonsense. But if retail is not really dumping in mass droves, if no one's feeling that mass fear, we're not going to get a VIX spike up around that 40. And maybe we're just stuck in these nasty throes of volatility until things ultimately settle down, which would probably have to come from the Fed, sort of taking a step back from such the hawkish stance that they've been having over the past couple of meetings. And again, I'm not here to say whether or not it's right or wrong. Obviously, they've got to do something about inflation, but that's the only other thing that I could see potentially bringing this back down and driving prices, or not really prices, but the VIX back down to that 2050 sort of area. So just some thoughts. Figured I'd put that sort of brain vomit out there for you guys to respond to. The last thing that we'll point out, and then we'll move along into the QQQ, is our SPX A200R, right? This is the percentage of stocks trading above their 200 simple moving averages, right? And I did want to just continue to follow up and say we are in the yellow box. I do think that this could potentially be similar to what we saw in 2008, right? Just based on this look alone. Again, I'm not saying that we're going to see the same magnitude of crash in the S&P 500, but so far things do look eerily similar, right? If you look about what happened here, we're coming from highs. We get a little dead cat bounce off of this 0.5 mark. Again, coming from highs, we get a little dead cat bounce around the 0.5 mark. Then we drive lower into the box, We've seen this sell off so far. Maybe we catch a little bit of a reprieve, boom. So we're sort of projecting into the future right now. Obviously, this is pure speculation. We get to here, that would be this sort of bounce in there, right? And then from there, that's where the pain sets in. We get that double move through the yellow box, something that comes back down into here. Just something to think about. Doesn't mean it has to happen that way. You could also say the look is very similar to what we had right here. So, okay, pretty correlated to the upside. Dead cat off the 0 or 50%. We move in and then back up. And if I just show you when that was, obviously that's your 2016, 2015 area. That's going to correlate to this area of the chart right here, right? So you get this move here, bounce, little double bottom, and then it's back off to the races for the bull market. That also could be a potential outcome based on what this is looking like currently. So that's been a sort of in-depth look at our S&P 500. Hopefully that was useful. If you guys continue to enjoy these in-depth sort of looks, continue to just let me know by leaving a comment down below, and I'll continue to give them to you guys. So let's go ahead and move along, get into our QQQ NASDAQ 100, and then we'll get into IWM Russell 2000 and the small caps. Same sort of ideas and theories will apply here in the QQQ as to what we just discussed in the S&P 500. If we can take out the two-day highs, look for the top end of this balance and the secondary resistance trend line here around 305.50. That's again coming from the same idea that if you have an H pattern, you undercut the low but then close back above. Shorts are not getting paid from down here. They might close out just added buying pressure that gets us into that 305.50. If we remember that this too could also be a look below and fail, that also supports the idea that we do move to the top end of the range. The lower edge of the weekly expected move is going to be filling the gap, which is from 280.49 down to 276.83. Notice that the low of Friday's session went right to the top of the gap at 280.49. So if that were to be retested, that's where I would expect that to break down and the gap to ultimately fill, getting us to that level 276.83 that we just pointed out to the downside. Continuing along, Russell 2000 IWM small caps, what's going on here? Really interesting stuff, right? If you think about relative strength, relative weakness, I have to say IWM has been showing relative strength. Think about this. An H pattern that we've seen in the SPY and the Qs both undercut the low from right around in here. IWM simply did not do that, all right? So we did have a hammer candle low that took out this level, but nonetheless, it certainly was not the low of the year. So going forward here, obviously any breakouts up and over 179 should get us for a back test here around that 184.50. And overall, if this is going to turn into a higher low double bottom, taking out that neckline and price acceptance above 184.50 over the course of time would start to sort of support the idea that risk on might be around the corner. We would, of course, want to wait for confirmation in our S&P sectors themselves, but this could act as a heads up indicator. If we just chop around, obviously chalk it up to neutral, and maybe there's potential for shorts underneath 174.75 because of the lower wick and the same implications that we've discussed in the SPY and Qs, I would probably just be patient and only wait for better shorts underneath 169 in IWM if we do something like this, lower highs, and boom, turn that into a flush point. But as of right now, there is relative strength in small caps, which you might find sort of surprising. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that, let's jump right into Apple. Same sort of idea that we've discussed in the broad market, right? This is the heaviest weighted holding in the SPY and the QQQ. So if we take out the 2-day highs here, we are expecting a rotation back higher, roughly into that 148 level here in Apple. Note that in its way will be 144. I would carry that forward as a significant resistance, but based on the hammer, based on the same sort of psychology and theories that we've been discussing so far, that could potentially be the quick dead cat bounce into the earlier part of the week. And again, we'll keep you updated on the Wednesday video as to whether or not we think these things will continue, or if we don't get them in the first place, what the next look should be for. So that's upside in Apple. Obviously downside, any consolidation down here starts to strike me as a bear flag in the short term, looking for breakdowns underneath 135 to get us into 126.85 and scrunching up the chart just to illustrate where that's coming from. Again, I know this might be a little bit of a pain to keep doing, but I do want you to know the structure that we're getting into that's coming from big double bottom in the past, and also in here some, it's really actually kind of, I would say this double bottom, fine, and then you get some support and then resistance and then choppy through it. So this kind of makes it a little bit sloppy, but a lot of interaction at that 126.86, which again is why you want to carry that level forward. Let's move along and get into Netflix here. What's the look for Netflix? Currently showing a little bit of relative strength. Again, just like we talked about in Russell 2000 and the small caps, notice that we already have a higher low in place. You could say that this is starting to build out a short-term bull flag like this. We've just been getting price acceptance higher. Any breakouts up and over 190 start to put the pressure on anyone who is short from in here. Remember, we discussed this actually last week. That same level is still in play, right? We've sort of already taken out any of the shorts who are down here with poor location, but as we start to move above 190, I imagine we start to take out even more of them, and we could potentially move into that 210.76. Anything that continues to consolidate in here strikes me as just neutral. I would be patient for the over or the under inside of Netflix, noting that we have 3 equal lows at 176.44, turning it into a flush point at this point in time. If we take it out, just look for your low here at 165. Obviously favor whatever the direction of the broad market is as we start taking out either the top or bottom end of this Netflix balance. Tesla taking the brunt of the hit there on Friday from our core list of companies. Absolutely nasty move here. We broke down underneath 700. We talked about that in the live stream. And I would also point out that we have this sort of resistance trend line here. Nothing bullish is going to happen inside of Tesla until that gets taken out. And that's on a 30-minute time frame, just clear as day here. Notice that we have resistance, 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 so on and so forth, just clearly marking these lower highs, lower lows until that changes, until we can at least start putting in equal highs, if not higher highs. I would remain in the bear camp here inside of Tesla, noting that we've been, in the grand scheme of things, breaking down for quite some time now. So overall, this H pattern has resolved. We came into that 625. Again, would I chase it short down here? Not really. Instead, the better short opportunity is a back test of 700 and that resistance trend line. Tight risk, right? Stop goes just above, looking for that rollover and trend continuation. Or if it takes it out, you stop out. And then there's potential for, if we do something like this, any higher lows that start to be established, look for here at 780.75. So obviously the first look is for shorts against the back test of 700, but from there we have some additional plays that we can take based on how the structure starts to unfold. Do we have anything underneath 625? 550, where's that coming from? Is it going to show up on our chart within a reasonable period of time, or are we going to have to go digging? Nope, it's reasonable. You can see 550 here, big big touch, and really off to the races from that level. So 550, definitely a significant support if we just see nasty follow through to the downside off of the back test of 700. Next up, we've got AMD. This one still just absolutely throwing me for a loop. I remember talking about in the Wednesday video the fact that this was kind of a nasty move, right? We had this double bottom in play here. We closed strong above it on the Tuesday session, then to just immediately reject off that 100, fails the double bottom, fails the 50 SMA. We do not get into the resistance trend line. Overall, this one is just quite nasty. I would start treating this as a range. I would say, day trades are fine. I can't really advise on those. Obviously, 15-minute patterns as we're looking at sort of daily charts here. But in here, day trades only. If we can finally re-clear 100 again, probably not even that comfortable on longs until we can break the daily resistance trend line, remembering that that comes from the all-time high inside of AMD. So really, longs are, a little bit sketchy inside of AMD based on this failed breakout that we've already seen here, and then breakdowns underneath 85 do open up the door for lower. Do we have a level mapped out underneath us? What do we got there? 73 coming from all of these instances of support from in the past would be my downside target if ultimately we do break down from this range. In the short term, like early on in the week, remember whenever you're in the midpoint of any given range, you really don't have any statistical edge, and that's kind of right where AMD closed on the Friday session. So I would use caution in this one and sort of put it on the back burner for now. Facebook's up next. What do we see in FB? Anything good here? Overall, really sloppy activity as well, right? If you think about this as a range, and again, here's sort of that midpoint, that's exactly where we are. Better longs will be produced up and over 202.15 with acceptance, and better shorts, as we know, first of all, we're trading for this gap fill. That's something that we're continuing to monitor for. That's underneath 184.85 down to 181. That will close the gap from this earnings cycle right here, and anything underneath that, obviously just thin structure underneath one daily bar there, down to 169 is the support. So overall, I would put this one on ice just like AMD and be cautious in the midpoint of this overall range. Better trades here for longs and better trades here for shorts, clearly with that gap fill on the horizon. All right. And targets to the upside, 210 coming from, we've talked about this level, a lot of significance from in the past there. Also resistance, support before the breakdown, right? 210 is your first target if we get a break up and over 202.15 early on in the week. NVIDIA's up next. What do we see here? Apologies for all of those gaps. Remember, we discussed them and we called them out in last week's video. But nonetheless, going forward, what do we have on the docket here? How does the chart look as we move forward? Really ugly with this sort of skew. Let me fix that for us real quick. There we go. That's looking a little bit better. So overall, here's an area of balance. Look below and fail. Look below and fail. Are we going to move back to the top end and the resistance trend line early on in the week? It certainly is a possibility and something that I would be monitoring for early on in this upcoming week. If we take out the basically Friday's high, right? That's your trigger for longs up to the top end of the balance. Now, don't get me wrong. That goes against what I was just speaking about, not getting overly active in the midpoint of a range, but based on two look belows and fail, that's enough for me to say, okay, there's at least the possibility that we could scalp this on an intraday 5-minute, 15-minute pattern up and over that prior day's high to get into this resistance around 182 quarter, 185 quarter as well, coming from the breakdown point there. So that's my early week sort of long idea here inside of NVIDIA. Breakdowns, still just let them sort of consolidate in here based on these two anomalies of breaking down with failed acceptance. I would want to see continued lower highs, at least 3 touches that turn 155.50 into a flush point, and then watch for the move lower after that. Your targets, we're not trading for these gap ranges, but they're just targets down below 148.71 down to 146.81. Then the next one is 142.80 down to 140.83. And after that, we'll of course keep you updated on the Wednesday video. Keep in mind, NVIDIA does have earnings this week, okay? And they're going to be after the bell, I believe, on the 25th. All right, keep that in mind. Next up, we've got Microsoft. What do we see on Softy? If we just quickly zoom in, we've got that same sort of idea as what we just discussed in the S&P 500 with the undercut of the low here. So a failed sort of H pattern, held for shorts. If we take out the 2-bar highs, then I'm looking for higher here. 261 will be a significant resistance, though, best illustrated on a 30-minute time frame. Support, resistance, resistance, support, breakdown, right? So overall, 261, I would carry that forward as significant resistance. Even this here, around 257.65. I don't want to get overly granular for the sake of today's video, but that's just the 2-day highs, right, that we were talking about. If that breaks, that's where we're looking for the move here, and then after that, into that 271, all right? So that's what it looks like on a 30-minute time frame. And again, 2-day highs, sort of break of this area. So maybe you're just patient and say, if we can take out 261, that's the trade entry, looking for the move into here, right? That's the long idea based on the failed H pattern, held for shorts. And if we just continue to consolidate sideways in here, we know we're just being patient, waiting for a balance to set up, a flush point to develop, and favoring the trend, looking for lower into 239 coming from, scrunching up the chart. You can see prior resistance, then turning to support on a break and retest in Microsoft before the big run of 2021. Continuing along, what do we have? Last but not least, the beast, Amazon here. Relative strength, really more similar to what we see inside of Netflix and even IWM, right? If we draw out an H pattern, we're not at the lows. We did not undercut the lows, and it's just kind of hovering sideways. I do think that the better long is still only up and over 22.55. We had a fake break here, rejected there cleanly on the Wednesday session. So patience, I would say something that does this starts to get more attractive for a backtest of this breakdown point around 2,400. So that would be the upside trade here early on in the week in Amazon. Any consolidation in here, kind of sloppy. I wouldn't really want to get overly short on this, especially noting, remember on the weekly time frame, this is really starting to get into oversold territory, right? Boom, 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 just nasty, nasty moves into, as we know, a really important area of prior resistance, which is now starting to offer some support. So I just wouldn't really be on the radar for shorts around that 2030. Just in my personal opinion, you're sort of trying to chase it after the move has already unfolded from right around in here. So that's been the core list of companies. Let's get into these ideas. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all of those buttons YouTube tells us to tell you about. And let's get right into these trade ideas, kicking them off with Roblox. What's going on in Roblox? You can certainly start to see the possibility, not guaranteed, but possibility of an inverted head and shoulders. If we can take out this sort of neckline up here around 35, look left, there was some pretty thin structure on the breakdown from here. I would say the next reasonable target could be around 42.50. Don't get me wrong, the 50 SMA might provide a bump in the road there, but overall, if this pattern starts to unfold based on a measured move, which would be from here to here, right, we could easily see that 42. So in Roblox, if we see a breakout up and over 35, that might be on your radar for a long opportunity. The same thing is going to happen here inside of ARK. We don't cleanly have a inverted head and shoulders, but nonetheless, we just have a clean area of balance. This was the one trade idea we presented on the Wednesday video. It never really materialized outside of the balance. So if we get a break up and over 44.15, if the broad market sort of bouncing on that Monday session, we have a target up above. It's roughly a range double and also prior structure from the breakdown at 47.10. And if it breaks to the bottom end of the structure, obviously you're just looking for the equal low at 35 quarters. So be patient, wait for the range to break, and hopefully if it's going in the direction of the market, you can take advantage of any sort of move that we get here. Next up, we see Coinbase. Again, very, very similar stuff here in many of these sort of, I guess they are tech stocks, right? Coinbase is a tech stock. Nonetheless, area of balance, if we take out the highs, boom, thin structure on the way back down. I would probably just start to target this gap here around 96, 100 as well. That would be your upside. And if we take out the lows, obviously, picture's pretty clear, coming back down for that equal low around 40.53. Okay, so just watch this area of balance inside of coin like you would inside of ARK or Roblox that we just saw. Pinterest is up next. This one's sort of coming back from the dead here. Notice that it's been on a little bit of a tear recently. I'll give it to it where credit is deserved here. The broad market was falling apart. Pinterest actually rallied off of these lows, and it did make a higher low from the earnings, right, call from back in here. So if this is going to turn into a double bottom, that's fine. We know that it needs to take out the neckline, but given the relative strength, I would certainly carry this forward as something to watch. Up and over 24 gets interesting inside of Pinterest to get us into that 27.50 level, which was resistant from back up in here. Where also, again, if we do get the break of that neckline, the neckline's already inside of this prior balance, right? It's not like the neckline is here at the low end and we first have to battle through this resistance. You can see on Friday, we actually offered up some support there. The lower wick of Friday's candle was right off the bottom end of the balance from in here. So nonetheless, I like Pinterest if we can take out the double bottom neckline at 24. Next up, and lastly, we've got Foot Locker. Big sort of fake break on the earnings call, right? Nasty inverted hammer here. We had this really, really large range that we've been trading in for quite some time. So you would have expected that, given that we've been consolidating for so long, and given that we were moving into a gap overhead, remember that this is from the prior earnings cycle, there should have been not a whole lot of resistance as we moved into and through that. And all of this pressure that was built up should have released for something that got us, at least closer, not a failed breakout. So because of that, I'm looking at the buyers as really weak here inside of Foot Locker, and instead look above and fail. We should be targeting the bottom end of the range here at roughly 28. So those have been the trade ideas. That has been a recap of our market. If you enjoyed today's video or learned anything new, let me know down below in the comment section or by simply giving the video a thumbs up. I appreciate every single one of you guys tuning in, and with all of that being said, I wish you a green trading week.